Welcome to your market brief for Monday, November 11th from the NASDAQ market site. I'm Caroline Woods. The Dow, NASDAQ, and S&P 500 set to open this week lower following last week's historic run. The bond market is closed today in observance of Veterans Day. Additionally, investors are anticipating key reports on inflation, production, and retail, with October's Consumer Price Index and Producer Price Index, among other reports, being released. Also happening this week, President Trump speaks at the Economic Club of New York on Tuesday, and Fed Chair Jay Powell speaks to Congress on Wednesday and Thursday. Plus, we'll focus on why Honeywell might be long in your portfolio. Shares have gained nearly 40% this year, but Barron says it's not too late to buy. And of course, earnings season continues. The significant companies reporting this week include CBS, Cisco, NVIDIA, Walmart, and Viacom. Helping to spin the news forward is Al Root, Barron's senior writer, who joins us now. Al, thanks so much for being here.
Thank you, Carolyn.
All right, so we have our fair share of data, economic earnings. We have speeches and testimony to pay attention to this week. But what should investors be looking at this week that maybe Wall Street isn't paying as much attention to?
Right, we got a lot of stuff still coming down the pike at us, but I think it's probably a good time to start thinking about 2020. It's always good to be out a little bit ahead of the data, and it's the end of the year. And we now need to think about what we're going to do in our portfolios for 2020, how we feel about the global economy, how we feel about trade, all of the issues that we think about sort of on a daily basis. Maybe it's time to take a step back and think about how next year is shaping up.
All right, so in terms of evaluating portfolio, let's shift to a single stock that you've been all over, Honeywell. Your coverage is a cover feature in this week's Barron's. It's a company that not only has exposure to China and the trade war, but also to Boeing. It's at all-time highs, up nearly 40% year to date, but you say it still has potential to run. Why is that?
I do. I've become a little bit obsessed with the Internet of Things and how companies are going to make money from all of this data we can collect off seemingly anything, and it goes into the cloud, and we can have computers crunch the numbers for us and tell us how to run it better or make things better without much interaction from humans. I think Honeywell has a good strategy for that. I think it can boost the stock. There's actually, you talk about the stock being relatively high. You could have almost said it's expensive at any point in the last 5 years, and it just keeps getting more expensive. Earnings keep growing. It's been growing earnings faster than the market, and that's really what we see going forward. It's going to continue to be a good stock, a good growth stock, something for growth investors that can grow earnings better than the market for the next few years.
Honeywell is, of course, one of the largest industrial companies in the world, but it's actually undergoing this transformation into more of an industrial software company. Tell us about that transformation.
Great question. So they actually have more software engineers working for them than any other kind of engineers, chemical engineers or aerospace engineers. And the CEO took over, Darius Adamczyk took over for Dave Cote, and he's really spearheaded this effort to sort of pivot the company from being a traditional industrial to what he likes to call a software industrial. And that means sort of capitalizing on the Internet of Things, taking all of the data that they collect as this 100-year-old controls company and using that to optimize assets in real time. It is a new era. It is one of these things that's sort of new and very difficult to get your mind around, but I think he has the right strategy. And even if he doesn't, it's still, like you say, one of the largest, most successful industrials with great assets in the industries where they compete.
All right, well, if history is any guide, there's certainly no guarantee that software as a strategy will work. We've seen the other case, I guess, with GE. We have to leave it there, but we'll certainly keep our eye on Honeywell. Al Root, thanks so much for joining us. Really appreciate your insights.
Thank you.
All right, let's quickly check in on last week's sector performance. The strongest performing market sector was financials, gaining nearly 2.5% on the heels of better than expected earnings and, of course, that strong jobs report. Now, on the flip side, the hardest hit sector was utilities, dropping nearly 4% in the same period, as Duke Energy was a big drag following a third quarter revenue miss. Now, moving on, Neuberger Berman is one of the world's largest privately owned investment firms with over $300 billion in assets under management. Joseph Amato is president of Neuberger Berman and serves as chief investment officer for equities. He's here now. Welcome, Joe. Thanks for being here.
Yes, good to be here, Carolyn.
All right, so first let's talk about sentiment. Futures are pointing to a lower open right now, but we're talking about record highs. We're talking about this historic run. It should be pretty exciting times, yet it's kind of a hated rally. Where is the enthusiasm, and is this kind of skepticism warranted?
Well, I think anytime you're at an inflection point of growth, because if you think back 6 to 9 months, the market's really been wrestling with this transition from essentially above trend line growth that we were experiencing in 2017-18 to a lower level of growth. And the question is whether that tips over into a more significant economic decline, the end of the cycle, a recession of some sort. And I think that level of sort of transition is what we're wrestling with. We think we're seeing a slowdown that will stabilize into essentially what is a soft landing.
A soft landing. So I want to ask you, because December, of course, was almost a year ago, but it's still fresh, I think, in a lot of investors' minds. Obviously, we saw some violent declines last December. What could drive similar price action as we head into the end of this year? And I guess, where is that risk?
I think the focus is on data, the economic data, and in fact, is this manufacturing slowdown, which we've experienced over the last 6 to 9 months, stabilizing. So I think watching that data closely is going to be important in the fourth quarter, and then as we move into 2020. And then second, we have the trade issue that has been bubbling up over the course of the last number of months. And I think the sentiment around trade has improved a bit, and I think that's partly what helped the rally. On top of that, we've seen decent earnings in the third quarter, at least relative to expectations. So I think the outlook for earnings more than anything, and then the trade issue.
All right, so earnings is kind of number one on your watch list.
Over the long term, markets follow earnings. Over the long term, there's certainly short-term disparities that occur, but if there is a pickup in earnings, I think that's what the market is expecting, which would support the levels we've seen, because we've seen the equity markets be up 4 or 5 weeks in a row now and achieving record levels.
All right, let's talk about allocation. Given the current environment, given the earnings that we have seen, I mean, we're kind of in the midst of an earnings recession, if you will. It's on track to show the third consecutive quarter for negative year-over-year growth. Given the concerns around China and the trade war and potential Brexit, how are you positioned? Where are you seeing the most opportunity?
So we think as it relates to the overall equity asset class, given where valuations are today and how far the market has run just in fact over the last 4 or 5 weeks, as we've talked about, we're reasonably cautious, and we don't necessarily want to chase the market higher in the short term until we see a confirmation as to how earnings are going to pick up. And you also have some exogenous factors out there like trade, even Brexit, although the Brexit risk seems to be lessened today than it was 3, 4, 5 weeks ago. But I think we need to see a confirmation and improvement in earnings before we start getting more aggressive on equity allocations.
What about in terms large cap versus small cap?
So I think it's a good point. Even though we may be cautious overall as it relates to the equity asset class, I think if you look beneath the surface, there's lots of dispersion. You've seen a significant differential between large cap and small cap, so we're more excited about small cap than we are about large cap, so we're more overweight small versus large. And also you've seen a big disparity between growth and value, amongst the widest we've seen in a long, long time. And we would lean more toward value given that disparity of valuations.
So there's still value out there?
There's still interesting opportunities below the surface.
All right, 2 things happening this week. We'll hear from both President Trump and Jerome Powell. Trade and interest rates have really been big market movers. Let's start with the Fed. Do you think the Fed will cut rates again this year? And if they don't, will the market be disappointed?
We think the Fed's on hold for now. The Fed has moved and pivoted. We were sitting here a year ago, we were talking about the Fed being on hold. The Fed, in fact, did a complete pivot and started to reduce rates over the course of the summer. And I think it was an appropriate response to a slowdown that we were seeing globally, not just here in the U.S. But we think for now they're on hold. But as Powell said in his press conference, he's watching the data very, very closely.
So the market, that's priced in?
I think the market's pricing in right now that the Fed's on hold for a bit.
What about a trade war end, some sort of conclusion? Is that already priced in, or does this market?
I think the market's gotten more excited over the course of the last 3 months or so that there's signs of encouragement, if you will, on the engagement level with the U.S. and China. I think the expectations we've had is there will be a, lack of a better term, trade deal light in the short term that would reduce tensions, probably be transactional in nature. I think the longer term trade issues, which are very legitimate, I think will take a lot longer to resolve and may not be resolved.
All right, well, we'll see if the president provides any clarity on that on Tuesday. Joe Amato, thanks so much for joining us.
Thanks
for being here. Thanks so much for watching. What do you think will drive the market higher in the next few months? Comment below and let us know. We'll be right here every Monday on MarketWatch's YouTube channel with everything you'll need to get the week started, plus a few interesting ways to play the market.